Okay, welcome to everybody who has been on time. Welcome to our September 2022 jobs and inflation recap. Today, we're going to discuss the current inflation numbers and how it's going to impact the jobs market, your purse strings, your purchasing power, and everything related to that. With us today is Dr. Riley White, Associate Professor of Finance and lecturer at University of New Mexico. In addition to teaching MBA students, he is the University Outreach Chair for the CFA Society of New Mexico, Chair of the Cassidy CFA Scholarship, and advisor for the student-run UNM Regents portfolio. He also has experience as an analyst for a large Boston-based bank, and today he's here to share his expert opinion on everything related to the economy, finance, and where we're heading, well, with his more esteemed crystal ball than mine. As a note, this will be recorded and we will be putting it on YouTube within 7 business days. If you have questions at any point in the talk, please drop it in the chat. We will read it out loud, and hopefully this will be enjoyable for you and educational as well. Over to you, Dr. White.
Thanks so much, Colin. There's no esteem here. I'm very happy to be here. One quick note, though, that is a biography that is a couple years old. So when we think about this, I'm also the associate dean and I do other things, and most of my life is administrative now. So I have a completely new set of completely parallel roles that I have to fill in. So I said, I'll keep updating it, and I'll keep updating it and send it to you. All right, guys, welcome so much. Thank you so much for being here today. And today we're going to talk a little bit about a couple of big things that happened. One, of course, was the jobs report from last week. And then we're going to talk about the inflation report from today and everything in between, including a quick slide I just flipped together on credit default swaps and Credit Suisse. Credit Suisse. So Credit Suisse. So let me go here. Whoops.
Oh, did you share screen? I
don't know. Colin, yes, I haven't shared screen yet, but I will.
Okay.
Sharing is caring.
Yes.
I can turn back time. All right, share. So let's do this. So let's do the September 22nd jobs report. Boom goes the dynamite. Dr. Riley White, Associate Dean at the Anderson School of Management, University of New Mexico, and Associate Professor of Finance and a bunch of boards and other things. Let's rock and roll. Let's overall, what do we got here? September 2022 jobs report. It is still good. So let's look at the job market as it stands right now. We have, in addition of 263,000 new jobs or so, launching us slightly above our pre-pandemic payrolls peak. Hooray, we made it. And let's pat ourselves on the back for a strong job market. Right now, unemployment also matched the half-century low of 3.5%. In to add to this bit of good news, before we get into a lot of other bad news, this is not going to be sunshine and rainbows. There's going to be sunshine, there's going to be rain, there'll be a hailstorm, and a bunch of things in between. But we were revised upward last July and August by about $11,000. Of that amount, 60,000 jobs were added in restaurants. This is kind of what we've seen towards the leisure and hospitality areas. Hospitality less so. Restaurants coming back in various responses to continued strength in consumer spending. 60,000 in healthcare. That's very interesting too. Healthcare, of course, being a particularly robust category to be in at this point. And healthcare, interestingly, if you ascribe to the sort of model of industry-based investment opportunities, where you look to see sort of a top-down basis how things are going, and play and invest in different industries depending on the macroeconomic situation, healthcare does typically do well at this time in late-stage economic situations. Construction, interestingly, up 19,000, despite mixed news in construction. I highlighted construction here because we know that at the same time, mortgage rates are skyrocketing to levels that we haven't seen. At the same time, and basically, in quite a few years, I know that we're approaching a 30-year mortgage rate of 7%. I think we hit about 6.92% today, and that's very, very substantial. And what that does is that lowers buying power substantially and also takes the steam off of new building as well as existing building. And construction as a whole is still doing okay. Likewise, as Colin and Albert point out here, ask any questions you have in the webinar statement. I'm happy to address, look at, consider any questions that we have. And those of you who are streaming in from Facebook and other places, you can ask away, and Colin and Albert will help get me that information. So no such thing as a silly question, only silly answers from me. Best part about being in economics and finance is most of our job is predicting the future, and most of the time we're kind of wrong. But, and we'll talk a little bit about this. But we do have good educated guesses about where we think we're going, and at least over the short term, not too bad of a track record, but could be better. The government jobs have been an interesting thing, and I want to point this out as well. We actually lost government employment in the last month to the tune nationally of about 25,000 jobs. Now, why is this the case? And is it because we're looking at government layoffs? There's actually still a substantial worker shortage in most government work, ranging that not merely just at the federal level, but we're talking about municipalities, states. In any given city or town, the government in many forms, either in the form of education or support structures within municipalities, are often the largest single employer. So it's a very, very important thing. But what disadvantage does being a government worker have? And that's one of the things is that especially at the local level, most places are unable to respond to changes in wages the way the private sector is able to. So what happens is if you're in an inflationary environment, and even if wages are increasing beyond certain rates, usually municipalities have much greater structure, more established unions, other things that require more detail and bureaucracy to examine things like wage increases. And so consequently, it's very, very hard typically for municipalities to keep up with the private sector. And now you've kind of seen that, and people are looking around saying, in addition to our really, really high quit rate, I'm going to leave this job, go somewhere else. Let me leave my government job for a private sector job that pays a bit more money. Wage growth. Now, this is a fun thing. One of the things we watch particularly in this perspective, especially as we forecast inflation, the engine of inflation in the long run can be driven by wage growth, but wage growth still tracks behind inflation to the tune of about 3.2% below inflation. That means despite wage growth of 5% per year, which is good wage growth in low inflationary times, this is horrible wage growth in high inflationary times. The real growth is negative 3%. So each given year, you can buy 3% less stuff, even if you earn the average wage increase in response to the inflationary pressures. And this is really, really hard. And across most sectors, this is the case. You'll particularly note that in sectors with particularly acute labor shortages, like leisure and hospitality, you're looking at numbers that are a little bit more high. I think leisure and hospitality, I think they're up in double digits over the last year. Labor force participation has changed a little bit. I'm not expecting us to see a change in this number drastically in the next coming months. Right now, it's about 62.3%. It might go up, it might go down, it might stay about the same. The long run is that we looked at it, we're still going to end up at a rate that's lower. If we think about the history of labor force participation, we saw rapid increases in the 70s, 80s, and 90s, leading up to the peak participation rate in the year 2000, before it's been dropping since. When we have recessions, people drop out of the workforce, they don't come back in full. This happened in 2008. This happened in 2020. We recovered most of those jobs, but again, people retired, and we're having massive demographic changes regarding older Americans in the boomer generation retiring, and fewer workers to match those original jobs. In addition to all the other problems we have, there are challenges in certain sectors. And we also are tracking behind in immigration to the tune of about 4 million fewer immigrants to this country than we would have had in 2017 if previous immigration rates had held, which means that we're still lacking in many sectors in jobs that were normally taken up by immigrants. And so this is fun to watch and see, and I'm glad that we've reached this level finally, and this is usually the sign of a good recovery, but there are some doldrums along the horizon that we're going to examine a little bit more. So let's look at first the employment change by industry between August and September 2022. So let's start this. So let's start over here. Education and health services. So just looking at the last month across the country, and these charts are courtesy of the Economic Policy Institute, very useful for charts, and they have some interesting dialogue and a very interesting website if you want to check it out. Education and health services grew by quite a bit, about 90,000. Leisure and hospitality, and again, when we say education and health services, most of that is health. Leisure and hospitality, most of that is restaurants. Professional and business services have been an interesting aspect of this post-pandemic recovery. So all of the business support, other things that you might be involved in, we actually are at a level, and pointing at professional and business services uniquely, if we look at the chart on the right, which shows what has changed since prior to the pandemic, in the before times, we actually have 1 million more people working in professional and business services than before. The nature of work is changing, and this is sort of what we're seeing. But other jobs are interesting. Manufacturing, despite an incredibly strong and abnormally strong dollar, the supply chain fiasco has caused continued improvement in manufacturing jobs as we look to reshore or onshore those jobs. Construction has been strong to the note here. Even mining and logging ended positive. Things that haven't been doing well, the government is one of them. Financial activities also interesting. And some of that is due to some volatility in the marketplace and other things and industry consolidation, but it's a fascinating thing, particularly as in normal situations, increasing interest rates usually result in greater profits for banks because they can increase their banking spreads. And so it'll be interesting to see how this ends up working in the next few months or so. Retail services are also down a bit. This number will probably jump as we approach the holiday season and we get more of those temporary hires coming in if they can find them. Now, going back to the overall picture since February 2020, what are the changes to the industries? We talked about professional and business services, all of the support, everything that's going on here. Transportation and warehousing, not surprising, right? When you have a supply chain fiasco, you're dealing with a rational economic response to improve or increase the size of transportation units, warehousing units, aspects here that deal heavily into the transportation networks we possess, to the tune of about 734,000. Now, Albert asks, do you think, given how retail has suffered through the pandemic, and now the ongoing recession, inflation will see an increase in retail hiring this year? That is a fantastic number. We know that people spend a lot of money during the holiday season, Albert, normally. And we know that temporary hiring happens, followed by layoffs that happen as a consequence in January and February as those workers leave. Now, retail as a whole has been interesting because one of the things, if you follow, and let me grab a quick chart here from Fred involving retail spending or retail sales. And if we think about retail sales as being a good estimation for how people are spending money in the marketplace, I want to kind of show you an interesting trend. I'm just going to I'll do a quick copy paste here. Oops, I realize that in doing that, I captured far too many windows. Let me open this up here and we'll grab some Fred. Here we go. Paste it right over here. So this is advanced retail sales. It's done. This is street finance. We're just going to do it like I'm on the corner and we're just going to do some finance. I love these questions. Advanced retail sales. Retail sales have soared dramatically since the 90s, as you expect. They go down in recessions. They're typically they follow economic cycles. They drop precipitously as everything closed in the pandemic, but their recovery in response to stimulus spending was massive. And one of the things that we've seen is sort of this recovery of the retail sector, the spending, everything that's happening. But I also want to note a couple of things, is that when we look at aggregates, we're not capturing the full picture of something. So an aggregate number includes everybody that we're looking at, all the total spending across the economy. We're leveling off right now in consumer spending. And if you notice this trajectory, this upward trajectory, this jump is leveling off. I would suspect, and this is heavily related to the economic response to the increases in rates that we're going to see from the Fed. And I'll go into a little bit more into this when we talk a little bit more about inflation. But we're looking at this kind of angle, and it's leveling off on the upward trajectory. And what this means is that we're looking at a situation where people are going to be less confident about spending. They're going to spend less, and there will be consequences for our retail environment because of that. I am not very bullish about the retail sector individually because of those reasons. I think we're going to start seeing inflation eat away at those sales and other things eat away at those sales. Obviously, ceteris paribus, one of the things that becomes important, especially for many states which have sales tax as part of their revenue structure, sales taxes and GRT, gross receipts tax, depending on your vicinity, are based heavily on the spending that happens in a given place or community. Everything equal, what we expect is that high inflation, as those prices result in higher goods prices, that results in higher taxes and more taxes that people pay. As a consequence, though, we're also looking at, with inflation this high, retail sales haven't slowed down by this much. We are seeing that. And we saw pullback as early as last December among Americans in the poorer quartiles of our income statement. So we see kind of our income distribution in the country. So we saw already, I think, this is a tale of multiple Americas. And one of them is if you're very, very rich and you have a lot of spending power, you're continuing to spend, and that's driving aggregate numbers. But we're seeing pushbacks, and those pushbacks are increasing, especially among lower middle class and now upper middle class Americans as they kind of grapple with inflation questions. So I'm not particularly confident about this sector. I still think we'll see the cyclical effects of retail, but I wouldn't be surprised if consumer sales this holiday season were a little disappointing. Next on. Payrolls. So let's think about payrolls. We thought about this, and one way to look at, where people are working relative to where they worked before is payroll. Total private sector employment is up 0.9% over the pandemic levels. So we flattened it, we've beaten it, but government employment still lags behind. And this is interesting. Will we recover those government workers that we lost previously? Right now, in the town where I reside, about 1/4 of available government positions are open, meaning that they can't find people to fill them up. And so as a consequence, we looked at things like this and we say, well, what's actually going on here? Is this something where we expect the government to be able to respond? Not effectively. The government cannot respond effectively to wage changes like we've seen. I suspect, though, if we do shift into a recessionary environment, government jobs will become more desirable ipso facto, and this shift will likely continue more away from the private sector into the government sector. So I think the only thing that will change this trajectory from a government standpoint will be a change in the economic situation. Christopher Lee, I don't want to give away because I feel like so I'm a resident of the state of New Mexico, so I will let you guess. It is one of the 4 largest cities. Juliana says, what might be the major reason for the recent layoffs in Christopher Lee, the famous actor? Thank you, Chris. What might be the major reason for the recent actors' layoffs in IT industry? Is there a signal of economic recession as mass media reported? Yes. Compared to the historical economic crisis we had, is there any? Okay, yes, I see what you're saying. So Joanna asked a very good question. What it might be a major reason for the recent layoffs in the IT industry. And we'll explain that a little bit because we're going to see that in the market index as well. The market confidence, particularly around certain aspects of the technology industry in particular, has been vast, and the consequences have been vast. And there are some reasons into that. There is IT, the technology industry in general is more prone to economic shocks in general. They do worse in bad times and recessions. They do better in good times. And as a consequence, anytime where you're looking for, and also when you think about the way a technology company works, and not just the very large players at stake, but startups, new companies, their value is determined by their expected rate of growth. And their value, as determined by the venture capitalists and angel investors and the market when they go public, is based on future growth, is one big present value estimation of the profits they are expected to make. And so when their economic horizon shifts from being very bullish to very bearish, this affects industries which are heavily weighted towards being growth industries and having a lot of growth companies in a way that can profoundly negatively affect them. So what happens is your growth trajectory is based on this in good times, and you expect a lot of good things to happen to your company, and as a consequence, to anticipate this growth, you hire rapidly. When that doesn't materialize and expectations drop substantially, and you expect a recession even, you have to go to your investors and say there'll be stable growth. That means you'll act a little bit more conservatively. That means you'll stop hiring. You'll lay off people that aren't there. And those realized growth numbers that you're projecting and you've been telling your investors aren't going to happen. And so consequently, you have to adjust and prepare yourself for bad times. So compared to historical crisis we had, is there any common thing? And that's a very good question. Is this similar to other aspects? This isn't the year 2000, I suppose, which is, of course, a uniquely terrible time for the technology industry. When we looked at sort of a crash of a large number of firms, the value isn't there in the same way, but it is typical behavior that happens during economic volatility and prior to recessions. So that's a really, really, really good question. Very, very good question. So this is typical, and it's going to continue to be typical. And I'll kind of give you a couple of signals when you think the market will come back. And the key is, the one thing you're going to look for is not only when the Fed stops raising rates, but when the Fed starts lowering rates, that's the time to reinvest and look at the economy as something that's reaching towards growth. Right now, the Fed's going to continue to raise rates to control inflation, and that's going to put us in some substantial economic doldrums likely over the next year and a half or so. And we'll talk a little bit more about that. So Colin and Albert were talking briefly about, one more thing about this slide too, I'm sorry. Year-over-year change in private sector nominal average hourly earnings. 5% for all non-farm employees isn't good enough. While we look historically, 5% annual wage growth is good. It is tracking far behind inflation. It is key to focus on real wages rather than absolute wages. As you know, if your prices are going up and, oh, by the way, your wages are growing up by less, it is evident to every single person that their buying power has decreased. 5% is great. And then inflation comes out at 8.2%. That's exactly right. Yay. But then no, not so much. So then as Colin and Albert were talking about, we talked a little bit briefly about this, so I threw together a slide in 30 seconds about credit default swaps. You saw this in the news in the last couple of weeks. I had to kind of pick something here that was interesting, because I know there's stuff that's happening in the Bank of England, which is I described it as terribly hilarious. It's horrible, and it's horrible for the people of Great Britain, and it's horrible for global economies, and it's horrible for the Prime Minister. But it was amazing. They shot themselves in the foot, and then they did all these other things to sort of, it's just horrifying. But it could be us. Well, I'm going to kind of do a little bit more of a deep dive into that next time around, because I do want to see how the markets interpret and what other things happen before I pass full judgment on the maneuvers of the UK in response to the Bank of England challenges. But one thing that you did read about was Credit Suisse, and in this very large international bank, there's been all this speculation. It's going to fail. It's going to do badly. And one reason for this was people looked at something called credit default swaps. And they saw that credit default swaps started increasing rapidly. And you're like, as non-finance people who live normal human being lives, I mean, even when I talk about normal human lives, I sound like Mark Zuckerberg talking about humans. Is it going to fail? Is it going to be good? What does this mean? What does this nebulous chart from Bloomberg show me involving the Credit Suisse default spread? So I want you to think a little bit about what credit default swaps are. So basically, a credit default swap is a bet on a company going under. And when it's a company going under, so if you want to sell one of these swaps, you believe that the company won't default. And so you're going to sell insurance that the company won't default for, in return, a quarterly yield payment. And that's going to be great. If you are buying credit default swaps, you're worried that if Credit Suisse fails, you want protection for the money that you are owed, the debt instruments you are owed. And as a consequence, you pay a quarterly yield to the person who sold this to you. So you're paying for effectively insurance that something will catch fire and burn. And when the cost of that payment goes up, it's because the default risk is anticipated to be higher. And what happened is that Credit Suisse had a massive increase in their default risk, similar to paying really, really high interest for really risky debt. This works the same way. The greater the risk, the greater return. People are offering credit default swaps only at these really, really high interest rates because it seems the market thinks that Credit Suisse might actually fail or it might default. And that's really interesting. So that's it in like a short amount of time. So if you're selling this swap, you want some periodic interest, some periodic yield. And it can help you leverage balance sheets and other things. If you buy credit default swaps, you anonymously transfer credit risk while still holding the actual debt instrument. And you also hedge your exposure on this debt. So it makes sense from a financial perspective. And that's why we have a lot of default swap markets right now. And if we look at kind of the overall markets right now, who buys these things? I mean, most of these things will be banks and hedge funds and insurance. About 22% of buyers are banks, 15% are hedge funds, and about 6% are insurance providers. So it's interesting. And so we did this, and the people asked, well, why is this the case? Why did Credit Suisse do this? We know they had a huge loss related to the failed hedge fund, Archegos, right? About $5.5 billion they had to write off. We know there was a $400 million fine for the Mozambique tuna bonds scandal. We know they were involved in the Bulgarian mafia money lending thing. And they're involved in all kinds of other things that were a little bit sketchy. So because they did this and they made this movement, people looked at this and said, is this large international bank going to fail? And will this form a contagion that affects every other bank? So in short, it's not going to be a contagion that affects every other bank. This isn't 2007. And although And Credit Suisse is still pretty well capitalized, meaning they have a lot of money. Now, European banks in general are less well capitalized than American banks. American banks had their reckoning in the Great Recession in 2008. A lot of banks, including the one I worked at, ended up taking on risks they couldn't handle. As a consequence, it took them years to build back that energy, to build back capital, and they've been much more conservative about the nature of that capital. That's one reason why it took us so long to get out of the Great Recession, is that it was a result of banks who lived very vicariously for a long period of time, suddenly becoming very careful about the nature of their capital and their risk. That hasn't happened in Europe in the same way, although this is still pretty good. Now, when you look at a question like Credit Suisse, we're not seeing, they're not in full crisis mode. This has to be observed. But the idea, one idea would be is what isn't public that the markets might know? And that is what people are trading on. What debt, what other liabilities does Credit Suisse have that might ultimately affect its downside risk? And in short, we don't know for sure. That's right. Colin asks, for reference, the big short follows the story of hedge funds buying credit default swaps on big banks before the mortgage meltdown. That's right. So if you're buying credit default swaps for the mortgage meltdown, that makes sense. The question is this pre-meltdown? And it's uncertain. We don't know precisely why. Like back in 2008, it was easy to see. Well, it wasn't easy to see, or else everyone would see it. It's easy to see hindsight, right? But it was interesting. And the Big Short's premise that banks were buying a lot of debt that was improperly rated by credit agencies and was actually very, very prone to default risk in response to an increase in interest rates. And it's unclear what precisely they're betting on right now. And it'll be very interesting to see how this pans out without looking into it. So those of you, I would think it's very, very important. You could look at it. Are they keeping an eye? Do they have exposure to the UK? Is it Italy? Is it other things? There's a lot of questions that might happen out of this. But just as a heads up, this is something we'll touch upon again next session. But it's something for you to keep an eye on, especially as this develops. So cool. Anybody else? Questions? So interesting stuff. So that was my 30-second slide from many graphics I could pull. So one thing that's interesting. So let's talk more about good news in the market. And this is good news only in the sense that it empowers the Fed. So to control inflation, the Federal Reserve is going to increase and has continued to increase interest rates at a near record rate, right? And when they increased interest rates, they increase one rate, the discount rate, which is overnight lending to large banks. And what this does is it has kind of a ripple effect on other transactions across the economy. So as the Fed increases rates, this makes investment more expensive. It makes investing in a lot of things more expensive. And as a consequence, economic activity drops, but so does inflation. And if you overshoot this, you end up in a recession. And that usually happens when we raise rates often. We actually have a really bad track record of raising rates and not having a recession as a consequence. But we're trying it anyway, and we'll talk about why the data might be a little bit noisy. So when we look at this, one thing that the Fed looks for is the response in aggregate of the job market to changes in sort of employment rates and interest rates. So obviously, the Fed had a historical, what's called the dual mandate. It wanted to do two big things. One was keep inflation near 2%, which not so good. But the other was to maximize employment, to maximize full employment. And so they pay a lot of attention to unemployment numbers because they want to see if their rate increases are affecting the unemployment rate. The good jobs report is a sign that, hey, guess what? The economy can handle more rates. People aren't being laid off yet. And so this is why a lot of people are coming and saying, based on the inflation figures we saw plus the job report a week ago, it seems to give the Fed a lot of leeway to raising rates again this year. And that's a very, very interesting thing because there was some hope in the markets that Fed would start easing their rate increases and that inflation would be a little bit more under control. And as it turns out, it is persistently high. So job leavers right now constitute the highest percentage of unemployed workers since 1990. That is the highest in 33 years. And what does this mean? Job leavers as a percent of unemployed. We look at the workers who are unemployed, 16% did so voluntarily. They left the market for this. And that is a sign that they are confident about the future performance or future possibilities that exist in the job market. Albert. Today's CPI print plus last week's jobs report will probably confirm a 75 basis point hike in November. I agree to this. I think we're going to see another 3/4 point increase because it's not having the effect on inflation yet that we've seen. But here's the hard part, though. As we look to questions around inflation and other issues, it's very hard to monitor, to make economic policy decisions in a very dynamic economy, because a lot of data that we have and a lot of data that we use is often stale. You know, I compare it all the time. It's like shooting a cannonball up in the air. And then even before it hits, you have to make an adjustment to figure out if you'll hit your enemy target the second time around while it's midair. And data is coming in all the time, and some of this data is stale. Some of this data isn't very accurate, as we'll talk about next. And there are other alternative measures that might indicate that, hey, maybe the Fed is having a more pronounced effect than it seems like it's having on certain things. But all said and done, even though we've seen a little bit of pullback from the quit rate, and the quit rate is the number of people who voluntarily quit their jobs. It's been high all summer, but it dropped to about 2.7%. This means that about 2.7% of all workers in any given month quit their job. Right now, if you're unemployed, 16% of those unemployed workers are actually job leavers. They leave it voluntarily around reasons that they're looking for another job that pays them better and offers them better work-life balance or any of the other characteristics that you're looking for. You might be in that perspective right now. Now, car wars. Now think about this. We're going to start entering into the inflationary pandemic. This has been very particular. If you happen to be in the unfortunate situation of having looked for a new car or done something else. Oh, yes, that's right. Let me go back to this. In a reaction to Albert, by the way, this chart's interesting. The last time it was this high was towards the end of the Reagan administration. Absolutely right. And then the only reason it went down again was we had that early 90s recession. And then we had the recession in 2000s. And then oh, wait, I'm seeing a pattern here. It shoots up a lot, followed by a peak, followed by a trough as we hit a recession. So recession right after the high point. Recession right after the high point. Oh, no recession yet. Maybe it will. Who knows? Let's keep an eye on. Everything's at 40-year highs. Yay, except my portfolio. Pandemic prices. Used cars and trucks experience unprecedented price increases. This has been very frustrating. You're in a position, you're buying a used car and found that many times the used car is more expensive than the new vehicle, and the new vehicle isn't actually available for you to purchase. This, of course, has its root in supply chains, labor force availability, and other things. But the long story short is used cars and trucks have remained stubbornly higher than even I anticipated in previous meetings here of the market coming back online and adjusting to these changes. It is very hard to find the materials necessary to do this. Initially, we had a materials crisis in late 2021, early part of this year. That has since gone away, but now we have still continued supply chain issues on products and services. Oh, this is fun. So Albert shares a story. He bought a used 2020 Hyundai Ioniq in May. I kept my alerts on since then, and I have seen cars of the same model year and older, more expensive than the car I bought, and with more miles too. You have an opportunity, Albert. You can resell a used car for more money. What a magnificent period of time this is. I also looked. I drive a vehicle because they're depreciating assets. I drive them for very long periods of time because they're more financially efficient to do so. And what happened was, I was looking at, similarly, I looked at the price of what my car would command, and it would be quite profitable. But unfortunately, I would then have to buy a new car or another used car, and I'd be in a situation where it'd be phenomenally difficult for me to buy so. So as long as mine keeps running with its 200,000 miles, I'll be fine. But new vehicles and used cars and trucks have both shot up in value. Now, this is limiting to a certain extent. It is incredibly hard to increase production, and production has not increased and remains below where it was in previous years. Car makers want to increase production. They cannot. As a consequence, we're dealing with this. Do you think track car loans as part of your numbers are starting to see more defaults on that yet? That's a really good question. Are we seeing defaults on car loans? And we were tracking that recently, but it's not anywhere near the high that we expected to see that would actually alter the nature of this market. So delinquencies are going up, but it's not at the level of a crisis yet. And I'm trying to find a graphic. This is where then I make a statement, and then I find a graphic to follow up and support that statement. Is this good research? No, it's not that. No, I know for a fact it is going up. I'm just trying to find what the most recent information on this. Let's see if there we go. Delinquency rates though, but this is mainly consumer loans. I can look at consumer loans here real quick, and this is a good example of this. And I'll show you what I mean by this. I'm going to grab this chart, and we think of consumer loans. A lot of these are auto loans, but the numbers are still historically low. So, but they're increasing, but not by a lot. So consumer loans, which are drawn by banks, look a little bit like this. And so this is the default rate. And obviously they shot up a lot in 2008, 2009. Right now, our most recent data is the second quarter of 2022. This data is usually more stale. And it's increasing, but not catastrophically. And that's fascinating on this level. This recession is transitory, Jay Powell. It is. It will be. Jerome Powell getting on the podium to do a Jedi hand wave. This is not the recession you're looking for. That's right. This is not the recession you're looking for. So it is interesting. So the hard part is with this is that demand remains high. People continue to drive. And as a consequence, car makers can't make enough cars to handle this. And let me see if I can get some car production numbers to show you why. Our domestic auto production remains unfathomably disappointing. And if we look at this in our most recent numbers, they've been responding to these increases and they've been getting behind them, but they are just struggling to catch up. I'm going back to Fred here, the Federal Reserve economic data. I'll show you exactly what I mean by this. This is the amount of cars that we're making. And obviously we've been going, we're heavily reliant on an international market for a lot of the cars, and that's perfectly fine. Global commerce works, except when there are big supply chain issues. And as a consequence, domestic auto production remains very, very low. And after the pandemic, we still remain below. If we look at our monthly production in units, around 164.7 thousand per month, as opposed to above 200,000 a month before the pandemic. This is a sector that has not recovered. You should logically, in response to the incredible prices here, be producing cars without abandon. And that is their intention, but they're unable to do so for various material costs. Silicon chips were then the issue, and a whole bunch of other things that were keeping production down. And so this is a phenomenal issue. Now, on the other side of this, let's talk a little bit about your portfolio. Oh boy. How's your portfolio doing right now? Is it good? Is it bad? Is it not so good? So you're probably looking at this and saying, well, you know, maybe you don't look at your portfolio anymore. Maybe you own stock in your company you work for now, and you're observing it, and it makes you horrified. So right now, and this is from yesterday's data, and as it was before today's slight increase, so it jumped back as we were talking about. We looked at about a 25% loss across the board for the S&P 500 since January. The Dow Jones dropped about 20. The Dow Jones, of course, the S&P 500, what are they? What do they measure? The S&P 500 is the 500 largest companies in the United States by market capitalization. That's the total value of their equity. That's the share price multiplied by the number of shares. And then the Dow Jones is 30 companies selected by the board of Dow Jones, the Wall Street Journal. And these 30 companies are considered broadly representative of the U.S. economy, and they usually track pretty well to the S&P 500. But on the other side of this, you have NASDAQ here at the bottom in that red line. That's down 33%. That involves a lot of technology-heavy companies from the Bay Area and other places are often listed on NASDAQ. So you're looking at your portfolio and being disappointed. You are not alone. And there's a few reasons for this. One, of course, is that anytime we approach the expectations of a recession, even though the job market's good and you're looking at all these other things, the stock market is a forward-looking instrument. And even if your earnings are good, and even if your earnings may have exceeded expectations, it's expected that given the volatility and the increased chance of recession in the next year, the market is incorporating that into its current value. And so think of everything as a future-oriented element. Oh, that's a good point. Albert says, maybe the U.S. car manufacturers will follow chip makers and onshore production from abroad. In my opinion, it's better for all of us. True, if you can find the labor, Albert. And that's the question. If you can find the labor, pay the labor, and make it happen in the United States, that you can. And that's true. And the other thing is one thing that lacks in the United States in particular, and I mean this fundamentally in the way that we train workers, is that we don't have a sort of expertise that, say, countries like that other developed world-class economies like Taiwan or South Korea does. in developing workers to handle, who are manufacturing workers to handle highly technologically advanced implements. Germany, for instance, had historically a very strong sector here, although they're struggling from another labor shortage as well. But so I think that in the long run, I think that these countries will still maintain a dominant advantage until the United States figures out how to train workers who can effectively manufacture these things. It's nice to say we can onshore or reshore something, but we actually have to supply workers who are able to do those things. And we can't really do that in this country. We don't have a good history or track record of doing that in the United States. And so consequently, that's why one of the reasons we ship things abroad. Bank stocks report tomorrow. That's going to be really interesting. And so one thing that we're looking around JP Morgan, Wells Fargo, Morgan Stanley, is there's something called a loan loss reserve. And loan loss reserves are kind of an allowance for expectation of losses. And you saw some news that a lot of banks were going to increase their loan losses. And this is sort of in anticipation of increased default rates. And or other losses and other things. It's going to be interesting to see how that plays out. Now, on the other hand, when rates are increasing, and again, think about the rates you're getting on checking accounts versus other things, they have not been increasing in tandem by all accounts. Given the high amount of economic activity and the high amount of continued investment, we should see still strong numbers for these banks. So even if the banks end up being good, or maybe not as, actually, it'd be very telling if the banks were not as good as we would anticipate they would be. Because normally rate increases are usually a profitable time for banks. So that's very interesting. Christopher Lee says, yes, in an ideal world, yes, but you can see AMD and Intel are not doing well and Supermicro isn't doing well. It is doing well. You can't compete with prices and quality from Taiwan. Agreed, completely, Christopher. Neil, what he's saying is become a nurse. Oh, yeah, that's good. I mean, I can't advocate that, but healthcare is on the rise. That's strong. It's good. Healthcare, there's going to be jobs. After the Bureau of Labor Statistics, healthcare jobs are huge. That's where the money is. Only because we're getting old and less healthy as days go on, and we're slowly. So yes, also, yeah, there we go. Ooh, and what a great discussion in the comment board. Now, Albert says that Chris, however, PC sales are lowest in 20 years, so it's natural chip makers also want to cut jobs. Very cyclical industry. Ooh, PC sales. You're right. Interesting. So as we follow the markets well, there are a few things you have to look for. One of the things is that when rates increase, this does increase opportunities for investing in other things. Historically, when interest rates are really low, people invest in the stock market because it's the only place where the risk-return relationship means they can get a good return. When interest rates come up, that usually means the stock market remains low. So one thing to look for, particularly from a signal perspective for your portfolio, is when will the Fed start decreasing rates to stimulate the economy, and that represents a potential buying opportunity because that will inject, that will be a form of stimulus that lowers the cost of capital for firms, encourages investment, and then encourages production in a way that can lead to better stock market gains. But keep an eye on that and see if that happens. Some people say we're at the bottom. I don't fully believe that we're at the bottom yet. And I think that that's preemptive based upon our economic forecast for next year. And so a lot of people always ask this. This is very common. They say, Riley, you know, we approach recession. Should I buy gold? Gold, gold, gold. Gold, is that a thing that we should buy? Gold. So let's think, why do people like gold and why do they buy gold? And not merely from the scientific purpose of gold as a fundamentally useful element. The reason gold, despite its industrial applications, et cetera, we know its value depends on the things is that as humans, we value shiny objects. And this particular shiny object with an atomic number of 79 has a particularly important place in the hearts of many people who remember the pre-Bretton Woods days when the U.S. and the rest of the world were on, the Bretton Woods days, I should say, when the U.S. and the rest of the world were on the gold standard, which was dropped in the early 1970s. Gold is interesting because, yes, it does go up prior to a recession, but at the same time, when interest rates increase. And what happened today was news that inflation was still high. That suggested that more interest rates will continue to increase. This increases options for investors to buy things that aren't gold that actually pay really good returns. Things like bonds and things, although bonds themselves actually did really badly. And Dr. White agreed. I think we are lower highs and lower lows. But when do you think we'll hit the bottom? When will the CPI report goes down significantly? That's a very good question. I think what we're going to do is I think there's a fair likelihood of a recession. And whether it's a Jay Powell style transitory recession or not, I think when the Fed realizes that when inflation is more under control because the CPI reports demonstrate a lower and more controlled inflation rate and the Fed eases off, we're going to look at, and this is the really hard part, because what's going to happen is as interest rates increase, this increases the cost of doing business for every company. The consequence of that will be a tighter job market. It will be a harder job market, I should say, where you're going to be looking at this job growth we've seen decreasing. That will signal to the Fed that they might have to stimulate the economy and lower rates, and they might do so, at which point then we'd be observing kind of where the bottom might be. But it depends. Every recession is a little different with regards to that question. And it takes a long time for us to recover. And there's a lot of noise involving that. But I think we're going to have some time before we reach what the bottom is in this. At the beginning, I remember I was at like Costco in like March. And and people, because they see me on, like, we have a local television station. They were like, hey, I get strangers who are usually above 75 because, they watch cable TV. And they're like, hey, what's the market going to do this year? What's it going to be at the end of the year? And they'll just shout at me and they'll be like, it's going to go down. And I said this, and they said, where do you think the market will be a year from now at the end of the year? And I said, it's going to be below where we are now. And that's where I think we're headed. And you can't argue how far down it's going to go. And I'm not quite sure how far down it's going to go, but it's going to be a rough ride for us. And we're all looking at this, and the number that we're key on is this inflation data and this big reveal. And thank you, those of you who've stayed along this long. I know it's 6:49 on a Thursday, and I'm so glad you made it. 5:49, I'm sorry, on a Thursday that you made it out here and did it. Inflation remains stubbornly high at about 8.2%. So we saw the slightest of drops in inflation, and more worryingly for us, when we strip away food and energy costs, core CPI, which as CPI, the price increases, less energy and food. These reached the highest level since 1982. That is a huge number. Gold, now do crypto. Wait, what about gold? Oh man, that's funny. So yes, what about gold? So gold is going to increase when gold is under pressure to increase when there's a likelihood of a recession, but it's going to decrease in response to higher interest rates because people have other choices to buy other things that aren't like gold that pay them higher rates, like bonds and securities and other things that offer them more money, not stocks per se. Now, inflation, on the other hand, when you have crypto, of course, has been touted as a test of the cyclicality of the markets, and crypto has also been tested as a potential source of inflation hedging. The market for crypto is very strange, though. It's more volatile in general. And I've written a few papers on crypto, and it's been something that makes it harder for investors to predict the same way. Yes. Christopher Lee points out, I wanted to say that the CHIPS Act doesn't prevent the chip makers from stock buybacks, which may not necessarily be good for the economy or even investors. So Christopher brings up a really, really good point here. And stock buybacks are really interesting. So back in the 90s, the finance industry wrote a few papers about this. It became fashionable to issue stock buybacks. When a company has a lot of money for one reason or another, it takes out debt to raise the money, it makes profits to make the money, they might go on the open market and repurchase their stock. By reducing the number of shares outstanding, this will have the effect of increasing the stock price, right? If you have a $100 billion company and you have so basically, let's think of it this way. If you have 10 billion shares trading for $10 each, you have a $100 billion company. And if a company were to say, well, I'm going to use some of my money to buy back some of those shares, and so then they only have 5 billion shares, they still have a $100 billion company, but now their stock price is going up from 10 to 20. And that's how stock buybacks work, or the theory behind it. And initially that was the case. In the early 90s, we found that firms were able to buy back stock and generate increases in revenue. Nowadays, though, investors are penalized. So even though we're looking at this has become so common, this is not a source, and investors are really, they have a lot of blindness with this particular issue. We actually don't see large increases in stock prices in response to buybacks anymore. And there are two reasons for this. One is investors are wise to this. And the second is that even though companies are buying back stock with reckless abandon last year and the year before, when rates were still low, it was not resulting in massive, and it wasn't the result of massive price increases that we saw, but it was But investors also look at this as a signal that the firm doesn't have anything useful to do with their money. If you have $10 billion, why are you spending it buying stock instead of reinvesting in things to generate the next line of equipment or factories or to increase your production? And so it becomes kind of a mixed bag for a lot of investors who are looking at this. This is very interesting. So it's very tricky to look at this. And so I'm very hesitant. I like the concept of examining stock buybacks in a very critical lens, although it's within the company's right to do so. When you think about the cost of raising money, it's cheapest to raise debt. It's much more expensive to raise stock. So a lot of companies, when the interest rates were low in the before times, through the recession before this year, when interest rates were low, they would buy back a lot of stock because it was very cheap to do so. And stock interest that we pay on debt is tax deductible. And so a lot of companies went out and took out a lot of debt to buy back stock to boost their prices, helping shareholders, but not really helping their investment in say, better supply chain. So inflation has been very disappointing. So let's break down inflation a little bit more. So one thing that we've been really bad at in general is forecasting inflation. We thought it would go away by now. It's still here. It's still present. And this is what I have to tell one of our local municipal mayors on Monday when I meet with them. And we discuss these issues as they plan their budget hearings for the next year. When you think about inflation, it is something that something we haven't really experienced in the last 40 years to this level. There are a few dimensions of this that I want to point out. Number one is that it's a global problem. When we think about inflation, we kind of are all in this. When we think about the interconnectedness of global economies, we're all very, very much aligned. And so inflation in the US influences inflation in the UK, it influences every other developed economy. And if we looked at harmonized core inflation across the world right now, we're looking at levels that have kind of come together. Inflation around the world, everybody is increasing and everybody is sad. Now, the question is can we break this cycle? And are there any elements along the horizon that suggest that we might? So one thing I want to point out is this. From the Department of Labor, Zillow, apartments list, Goldman Sachs, all these things. So let's look at rent. Rent costs formed a big part of inflation environments that we've seen. We knew this would happen, right? We knew that inflation was going to, because it was so driven by housing prices, as well as apartment rents. So initially, interest rates were really low, and that helped fuel, and by interest rates, I mean mortgage rates, in response to low 10-year bonds dropped precipitously in 2020. In early 2021, the prevailing mortgage rate, the 30-year mortgage rate, dropped to 2.65% on average. And what that means is since then, it's gone up to almost 7%, exceeding 6%, and just today, 6.92%. This has reduced buying power substantially. It also means that lower mortgage rates incentivize real estate prices to go up and be bid up to higher and higher levels across many parts of the country, particularly in the West, although in the Bay Area, because prices were already really high, as a percentage point, it didn't go up as much. As a consequence, people started being priced out of things like house buying. And so there was a lot of demand on apartments. And as a consequence, apartment prices rose. And so now we're in a situation where you have both increases in prices in houses and apartments. House prices are kind of leveling off. And we do think that apartments are also kind of unsustainably growing. And so is there a sense here that there's something bad happening? That's true. Lots of bridges hacked and winter is coming. I believe in crypto is going to have its own version of a reckoning, but it's going to sort itself out. Some new, it's like betting on tech stocks in like 1996 with crypto. One of these things is going to be around for a long time, but you can't tell if it's going to be pets.com or whatever Amazon was. And you have all of these other things, and you don't know which one's going to be the mover and shaker and be actually valid for practical purposes. But it's the thing. I mean, how are you going to call it? It's hard to call it in the 90s because the internet's important, and a lot of people think it's cool in 1995. And you may have your own GeoCities account, like I did, /magic /rainbow unicorn /Riley White's pre-economics homepage. I was actually one of the first jobs I ever had was I was a website manager for in the 90s when I was a teenager, for the Youngstown Hawks, a minor league basketball team located in Ohio. And that's a trivia point. It was good. It was owned by Ted Stepien, who hired me and he was also famous because he used to own the Cleveland Cavaliers for a long period of time. Not a short period of time, where he fired a bunch of coaches and then they had a Stepien rule named after him, which you can look up. Anyway, Albert says Dr. Wright might have been playing Maple Story back in the day. I refuse to comment. So anyway, paying the rent. So here's the thing about this. The CPI number is the gray line in this chart. Follow the gray line with me here for a second. So let's compare, when we look at how the Fed interprets data, how CPI interprets data, look at the gray line here. That's the rent of primary residence. That has been going up substantially, the percentage change. And the way that it's computed, they look at aggregated data, it's over time. Notice that CPI has been increasing relatively steadily. Now, this rate is a lot smoother, but also on the trajectory, a very upward trajectory over time. Compared to what we actually observed in Zillow and Apartment List for asking rents and an observed rent index in Zillow's case, we saw a massive increase in 2021. This has since dropped substantially. And although numbers are still high, the rate of increase has dropped substantially. So we're observing those marginal rates, those new rates that we're seeing in recent times have gone down substantially, which leads us to another question about data. What data are we operating with? And I'm not arguing that the CPI data is false. I'm arguing that CPI data often doesn't encapsulate the full picture. And is this a story of hope? So the primary rent, another way to look at this, also increasing in that yellow line here. Look at the Zillow observed rent index. It increased rapidly up at the beginning of this year. It's now coming back down. It's likely to continue coming back down because it's unsustainable. Now, when will we see that in the CPI? Not for a little while. One of my favorite things about the CPI, because the consumer price index is a representative basket of goods that kind of estimates what approximates an average expenditure for a US household. And so shelter is obviously one of the single biggest components. And so as a consequence, core CPI is going to increase in response to the changes we've seen in shelter. And it's also going to be bad next month and the month after. But we are seeing that since the markets are shifting, this will eventually flow through to CPI, although not probably for a few months down the line. Now, Justin Wolfers, a pretty good economist, you're interested in following him, an awesome economist, had a very interesting WTF involving CPI. He pointed out, and I confirmed this by looking at the data myself, the cool part about CPI is that it's very thorough. They also have a lot of nuances here. If you look at a data item within CPI, food at employee sites in schools, that CPI data rose 45% in 1 month. And 91% over the year. Okay, let's think about this. And this is still baffling to me. Food at employee sites in schools. When you're at work, you're looking at food, maybe I don't know what precisely this means. Is it school food, other things? We're seeing massive increases, about 91%. But the question is, to Alberts, I mean, this is a really good question. Is it because food companies and schools tend to be subsidized and free lunch programs? I have no explanation right now about why this is the case, but it stood out particularly on the CPI, and I downloaded all the data and looked at it. So it's just fascinating stuff as we go into this. So a lot of these things a lot of this are collected from data and surveys and estimations, which might not be fully accurate of the entire system. But long story short is we are shifting away from those shelter price increases. We're observing that shelter is slowing down in rate. And as a consequence, we should be seeing that into CPI next year. Right now, though, it looks like CPI is just starting to capture in the upward trend the increases we saw at the beginning of the year. And consequently, that's driving a lot of what we're seeing in value. So is that relevant? Okay, questions about this, anything that you've got. And then I'm going to go down into our little 2 slides of Bay Area breakdown and take it open for broad questions. So I don't know the answer, Albert. I actually don't know how those things would be affected. I mean, we're not seeing are we arguing that maybe food is subsidized and then are we arguing that there's more free lunches or fewer free lunches on this program? It's a fascinating. I don't know. It's a really interesting question. We have right now, this is a big issue here right now in the city of Albuquerque in New Mexico, in the city of Santa Fe. Those rates are about 68% and 74% in school districts where students qualify for free lunches. And it's the same in many California cities and other places as well. So
going back to the inflation data.
Which one?
Before slide number 10, I think. This is what we're looking at is core CPI here. Yeah,
just core CPI.
Okay, yeah. I'm concerned because we currently have an OPEC issue where Saudi Arabia is cutting down on oil production. And
Yes, OPEC, yeah.
as we saw earlier in the year when Russia and Ukraine got into that hot mess and oil production went down, are we going to expect a similar increase in energy price, which will impact the rest of the market?
That's a good question. One thing that's very interesting to note is, especially as we look at oil production, OPEC is a lot less important than it was back in the 1970s. And this is very interesting. You ask why? Why, Riley, is that the case? The largest oil producer is the United States has become Saudi Arabia in the world with regards to oil. We actually produce almost double. We produce almost around 20 billion barrels a year, 18.8 billion barrels of oil per day. I'm sorry. But we consume a little bit more than that. We consume about 20 million barrels. Chris Lee, you're absolutely right. This is straight off of Bloomberg. That's where you get the cool data. If you're interested in an MS-DOS type format, and you find it comforting because it reminds you of a bygone time. I like it. It's fun, isn't it, Chris? It's Christopher. It's really good, isn't it? I enjoy it. And once you get used to it, it has some really cool data. It updates very quickly. It's a very fun way. It's also really, really expensive. And so, we happen to have some access to ones that's been funded by an outside company. So it's very pleasant that we can use it at times. So when we think about inflation and oil prices, OPEC just isn't as big as it used to be. And I'm trying to get a good chart here of global oil production by country. The US is the biggest one, and we've had technological advances in things like fracking and things like the way that we've done and harnessed oil out of the ground. Three biggest states for oil production are Texas, New Mexico, and North Dakota in this country. Because of that insulates us a little bit, and we do make a lot of oil, and consequently that keeps us from experiencing the sort of price-related shocks we see in other parts of the world, or what we used to experience back in the 1970s. However, oil being an internationally traded commodity, anytime where you turn off the spigot to oil, that reduces the total amount of barrels produced, which does have an effect of increasing price. And so what we're going to see is abnormally high gas prices as we approach the holiday season, which is normally a time when we see kind of what happens is gas prices peak in summer, and they kind of do this thing. They level off, they go down all the way through early winter, and then they go up again in May. And this is going to throw a wrench into the cyclicality of oil prices, but it's not going to be as bad, I don't think, as it was in summer, and it's not going to be that bad because we're talking about a production drop that isn't going to destroy us. And so consequently, looking at this and looking at US production as a whole, and also with the consequences of the sanctions on Russia, there is going to be a continued era of higher gas prices in general and higher energy costs in general. And so that is something to be aware of as we approach the coming year. And as your point is that will this affect inflation? I mean, if we have this this is priced into Brent already, and it's priced into West Texas Intermediate. Let me grab that data here real quick. So right now with WTI, West Texas, there's two global ways we price oil. One is through West Texas Intermediate, which is sort of the price of the oil as determined in Cushing, Oklahoma, looking ahead to the next November 2022 options date or futures date. We have about $89 a barrel on oil right now. It hit 121 barrels of oil back in June, and we had that shock earlier in March where it shot up to 120 something as well. So right now we're not there. I don't expect it will go up there, and I think what we've seen is the aggregate price increase from like 78 last month to 88 is the extent of what we're going to see from here, but it's still going to keep us expensive, and that's going to be a bummer. Albert says, I forgot, how do you think all this economic data will affect midterm elections? It's not going to be, this is really interesting. So we know consecutively that if we look at economic data and voter preferences on this, because we just had our university did a thing and they're like, how will this affect the election? And I'm like, I got numbers for this. And they called me out of the woodwork because it's not that I'm the best guy for this. I'm just the guy who's there. And so they asked me a bunch of things about the election. And what's going to happen is as we approach the midterm elections, and that'll be really interesting, particularly as we do our next session, which will be after the elections. So right now, inflation, bad news. So economic data remains substantially important. And if we look at the recent Gallup poll of what voters look at, what are their most pressing issues, the economy and inflation is the most pressing issue. People with different party affiliations view it differently. People who affiliate with the Republican Party view it much more importantly than people who affiliate with the Democratic Party. When there's bad economic news, people associate it with the party of the president in power. And there's a few motivating factors here. And when we think about this, it's bad news in general for the Democrats because of that reason. But at the same time, the economic data is mixed. We're not in a recession. We have a strong job market. We have other things that are well. Inflation is high and wages aren't keeping up. That's bad. And so it's likely this will, the way that we view the economy will be influenced heavily by our partisan point of view or our partisan background. It will likely mean, though, and if I'm a betting person, I would say it seems more likely than not that the House will go to the Republicans, and I still think the Senate is a bit of a toss-up. And I think a lot of that will be guided by voters' preferences on the economy, but there's a lot of other confounding issues this election that I think voters are also motivated by. But the economy was the most important thing that people cited in the poll that I read. Yeah. Oh, Senate is 68%. I believe that, Chris Verley. I still 66% is a slightly weighted coin flip to me. But yeah, I think it's still, I think that's probably likely. National Bureau of Economic Research releases Q3 economic numbers on 10/23. That'll be interesting. If GDP fell for a third consecutive quarter, which might happen merely because inflation is high and real GDP is going to go down, then yes, that will be other bad news that will be exploited probably and politicized on any level of that level. Politics is complex, economics is complex, and when they combine, they produce additional complexity. So when we look at the Bay Area real quick, let's go down to the Bay Area for a second. Employment rates over the summer was steady, not steady. I can't believe I've had this slide up here with all these typos. While the labor force expanded by about 5.7 thousand. So we look at the civilian labor force between July and August, we actually saw more people in the labor force in the Bay Area than we've seen basically all year, which is a good sign. People coming back online looking for jobs, but the number of people who were actually employed in the Bay Area remained pretty steady. Unemployment rate remained pretty low, about 2.8%, but the addition of those more people looking for jobs meant that unemployment rate actually increased from 2.6 to 2.8%. Now, across the board, I was searching for a story in here and I didn't have one. And so the problem is that this is hard. I was looking at last time we saw, a jump in internet. Everything's been really, really steady. Even the drop that we saw in government in response to sort of that fiscal year change from June to July, that hasn't occurred in August either. So compared across the country and across the country and across neighboring counties, the Bay Area is doing pretty well from an unemployment standpoint point of view. If we compare the last year, about a year ago, we were talking about a 5.3% national unemployment rate. Now that's 3.8. And actually, in September, this has dropped to 3.5. We don't have September numbers for individual regions. Those are released later. So as a consequence, Bay Area numbers haven't been released yet. So I'm comparing August data. California, of course, hit 7.2% a year ago. We know that as a state as a whole, California usually responds with higher unemployment rates during times of recessions, and then it drops pretty effectively as the economy recovers. California's unemployment remains tracking higher than the national average at about 4.1. Now, the good news for the Bay Area is the Bay Area unemployment rate remains very, very strong. In San Francisco County, San Mateo, everybody across the board has lower unemployment rates than the state and national averages. And these improvements have been pretty steady. So take that. So San Francisco in general, we don't cover Santa Clara County, Chris. I'm just kidding. We cover only Real County. And this is a good question. I can actually look that up. But off the top of my head, let's see if I can grab that real quick. I knew there was going to be like my, San Jose crowd was going to come in on this. They're going to want some more. Man, not working. Anyway, I'll keep you. Let's see if I can. I'll see if I can grab it. I grabbed this data from. They produce a little report on the Bay Area, which is very interesting. I know you're the biggest county in the Bay Area, Christopher. I know. But we combine these things. This is. Am I too biased towards my, the peninsula folks? Is that what it is? Is it one of those things? I mean, my family's from, Castro Valley, so we're from the other side of the bay. So that's why we have Alameda. But You're absolutely right. I'll go into more detail later. It's actually covered on a separate report, but actually I can get that. It's in the San Jose economic breakdown. I can grab the San Jose BLS 2 economic summary. I will say this though, when you think about the San Jose economic summary, here you go. Santa Clara, right about 4.7 last year, 2.3%, Christopher, nowadays. Thank you. And I apologize, those of you who are hanging on here looking for San Jose area economic summaries, and I forgot them. Thank you for your patience. So, and if you want to go down to San Benito, it's about 4.2% there. Cool. Got it, Chris? And so Santa Clara, what makes Santa Clara cool is actually it's not. They're dropping. They usually drop and follow in tandem San Mateo and San Francisco over time. And there's a lot of interest here. And actually, let me see. I'll continue. I'll grab some additional data as I see it. Thank you. I know. It's like you get no respect. Now, here's the thing. Every once in a while we get somebody from Stockton, and that's rough. So dashboard to the Bay. So let's look at the 12-month changes in unemployment. When we think about unemployment, these aren't real numbers. These are just the physical changes in numbers. So as you saw, when you look at the drop that we had across the country in August, I think that is true. It is eclipsed by its. That's a good question. And it's a good question, Christopher. And I know this is I see, I will show San Jose the respect that it deserves. It's a town, it's got 1 million people in the city itself. Like it's nothing to sneeze at. And you have this, and there you are, like being ignored and abandoned, like in the snow in the Bay Area. And we think about this. It's terrible. It's just not fair. So I'm with you on this. You've got, maybe I have, that's right. I got this. Santa Clara University is always fun. You have San Jose State, you can technically, you can claim, you're only, like what, 20 miles from Stanford. So it's good. You got a bunch of things. There's a bunch of things to love. So what this means is, if we look at the US versus San Francisco, the United States, we saw a bounce back in employment very effectively across the economy that was initially higher than it was in the Bay Area. But the Bay Area has remained consistently stronger in month-on-month job growth. And if we look at the physical change in employment, then over the preceding 12 months, then the United States as a whole has been, and that's been very encouraging. On the other hand, there's a few things to note. Number one, of course, is that when we look at things like CPI, food and energy, US city averages have actually exceeded the San Francisco Bay Area in their growth rates. The reason is, though, not something necessarily to be proud about. Things were already really expensive in San Francisco. When we look at annual expenditures, the way people spend money in the US versus San Francisco, if we look at 100% of your budget, how does the average San Francisco resident spend their money? 38.2% of that goes to housing, 11% for transportation, 10.8% for food. You end up in a situation where most of the time your pool of money is bigger than the rest of the United States, but those ratios, relatively speaking, are smaller. The closest place, interestingly, as a trivia factor where you spend about the same per year as somebody in the rest of the country, both about $5,000 each, is in healthcare, which is encouraging. Over the last year, selling prices received by producers for selected industries, things like freight trucking, hospitals, and hotels, all of those have seen massive changes in PPI. That is an incredibly large amount of growth that we've seen. And when we look at hourly wages across the board, we know wages have not been keeping up. And although wages in San Francisco exceed wages of the United States, the ratio of those wages differ by industry. So for instance, back to the question, that Neil's question, should I be a nurse? So one aspect for this is maybe if you value, and you look at this, and one way to look at, say, where wage shortages exist is to see the premiums paid for different occupations in a given region. And so across the board, we know, and it's easy to see that San Francisco pays higher wages than the rest of the United States for living standards, et cetera, et cetera. On average, this is about 48.6% higher than the US wage. Now compare that to nurses. And if you're a nurse in the Bay Area, compared to the US as a whole, you actually get about 83% higher wage. So technically, if we're looking at the way that different industries are valued within a region, you have a bigger premium for being a nurse in the Bay Area than relative to other industries in the Bay Area, which is interesting. But likewise, if you're a chef in San Francisco, your premium is negligible. And so it depends highly on the industry and how you get paid. So think of it this way. So maybe this will shift Albert's list from being a primarily composed of chefs and head cooks into people to earn higher premiums above national averages based on where labor demand exists, like in registered nurses. Dun, dun, dun. Fine heads. So anyway, follow where the wage premiums are, and that's a good indication of where there might be labor shortages and demand for given industries. Questions? Also, why do you have so many chefs?
How are these occupations selected? I'm kind of curious about that.
They're the 6 most common occupations on Albert's list. I don't know. I'm just kidding.
Yeah, it seems like a very weird.
It is random. They're random. They're randomly selected by an accountant. Yeah, they're by an account. That's why accounting.
Electricians and not plumbers.
It's very telling, though, and you can go through this. They actually have occupational and wage statistics across the board for this. Oh, since Albert asked, since COVID has changed things so much, do you think the Bay Area would rebound the same way in the recession post-22 as it did pre-2020? That's a very good question. I know people are looking at remote work in the Cal Exodus and Stanford, looking at the questions of, so that's a good question. And so this is always said, so yes. So it is likely that there will be continued decentralization of some industries, or deconcentrating of some industries as they sort of move out of California, or they may go to other places. But the Bay Area still remains an innovation hub for the largest single innovation hub in the country for entrepreneurial businesses. It has the largest workforce related to some of the most competitive technological fields that are there, and as a consequence, that will continue to attract employment and revenue. But that said, will that affect their recovery in the future? And I would say the proof is already in the pudding. And I'm going to say that no, because we would already be seeing symptoms of that now. And if you are dealing with, as a major metropolitan area, one of the lowest unemployment rates in the country, period. And that low unemployment rate is a signal of the strength of the ongoing economy in this region. And you're doing so without substantial changes to the size of the labor force, even though people are moving out. Albert, thank you. I know, Chris, that's true. It was just our continued joke and that was one of my justifications when we talked about the Cal Exodus previously, was looking at Stanford and saying you have universities, hubs here that are unlikely to move elsewhere. And as a consequence, these very effective hubs are going to be things that allow you to continue to foster and develop economic leading industries. And this is not capsulated. This just doesn't exist in other places. And I know I was in Austin last week, and that's always a fear. It's like, is this a new thing? And it's not the same. It's not the same vibe. It's not the same feel. And as a consequence, there is a limitation in certain areas' ability to extract growth from the Bay Area. The Bay Area is surrounded by fundamental benefits and advantages that it has. And as much as I have, as an external provider, opinions about, say, zoning and regulation that might happen in the state, that's something that California is working through right now in a lot of very interesting and promising ways. So I'm actually very hopeful, actually, for the recovery following a future recession. And I think you're going to see continued economic activity, and I think you'll see continued economic growth. And I think the fact that San Francisco, not in the Bay Area and San Jose, have maintained much lower unemployment rates than the rest of California and the rest of the United States is telling of the strength of the industry right now. And this is not, you're going to read bad news because it's going to appear bad relative to it's bad relative to good times, but the industries are here and they'll continue to be here. And I think that's going to be an issue in the future. But it's something to watch. And I do think that prohibitive real estate prices is a major downer in this. It's not going to be okay, Chris. Nothing's going to be. I mean, Albert, nothing's going to be okay. It's not nothing. Everything's gonna. We're gonna have an economic recession. The unemployment rate's going to go up probably, and hopefully it'll be brief. But maybe it'll be. And this is hard to say. We don't know yet. We don't know yet. So, but it'll be tricky. But I think that the Bay Area will weather it well. And if anything, one thing that does need to have, we do have to figure out, we've chronically underbuilt real estate in this country, and as a consequence, we have very high real estate prices. So it's a thing. And the way that we build real estate, the way that we look at things, the way that we look at property and development, this has to change. And I think considering that most people own a majority of their net worth ends up being in the property that they own, it becomes an important factor that can attract or detract people from moving into the area. I do think, though, you will have a fundamental, like the rest of the country, immigration is a problem. We need more immigrants. And I think that emigration from California will remain a problem for many people who are priced out of the real estate market and want to go on to greener pastures and own a house with a reasonable sum of money. And that's going to be a factor. And real estate prices temporarily, and I think the recession will tame inflation. I think we're going to tame inflation through this or another. It is really, really hard to develop a stagflationary environment in the same way that we had in the 1970s. We're going to see a decrease in economic activity probably, and consequence inflation will have to go down. But because inflation is also a trailing 12-month number, we're not going to see those values decrease meaningfully until the economic system starts kicking in and we get these rate increases coming across, that the Fed increases, and we're actually making those changes in investment decisions. I know it's weird, isn't it? It's interesting. And real estate prices, and that's the hard part. I mean, there's no precedence for real estate prices that would bring, the average cost of real estate anywhere in the Bay Area down to what would be reasonably considered affordable. But you have a potential to, there is a potential to look at the way you build and develop units in a very meaningful way to accommodate housing shortages that I don't think has happened in aggregate. When we get to January 2023, what will the number look like? So here's what we're going to see. So aggregate numbers are going to be tricky. The core number, let's look at this. Core number's up because the CPI is increasing shelter. So for the graphs that I showed you, and this is going to be interesting, I used to think, my thoughts a couple months ago have changed. I thought core CPI would remain at a level that was manageable and lower than it is today, only because, I expected this turn in apartments and shelter to be reflected in this data more recently. The way CPI collects and interprets survey data and evaluates this data, it is lagged. And as a consequence, CPI is just now really taking into account the massive year-on-year increases in rental prices that we've seen. So as long as this CPI number continues to go up for rents, and it's going to, the best case situation is that it ends up kind of looking like this little hill as we approach September, August, October, and November. I think this number is going to go up, and that's going to keep core CPI high, even as the Fed continues to raise rates in the next month. But then what's going to happen is this will shift, and it might shift quickly as we sort of get out of this. And the question is, as the Fed increases rates, and remind you that the 30-year mortgage rate doesn't follow the Fed rate, but it does follow 10-year bonds. And 10-year bonds also increase pretty rapidly in response to this. And if the mortgage rates continue to go up, it's impossible not to imagine a situation where real estate doesn't at least correct itself, where it goes down somewhat in value from what we've seen, because it's priced, most of the market is priced out for affordability. And so because of that, I think in January in 2023, our core CPI numbers may get a little higher in the next couple of months. And my hope is by January, they've turned a corner, and we're looking at, and let's see, we're looking at October, November, December, that they're probably where we are now and maybe a little bit lower. But also we're going to start looking at those job numbers in greater detail. We're going to have retail data, and we'll have an essence to know, we'll have a better idea of whether there'll be a recession in January. So I'm going to keep an eye on this. I think core CPI, because of the way it incorporates inflation, it could go up a little bit more, but and that's going to be bad. But the long story short is that the shift is coming, and this wave is going to reduce inflation through 2023, even though it's going to take a while. So Casey says, given the data lag compounded by the response lag by government Fed, also shout out to Casey, one of my EMBA students, really excellent. By the government Fed, how do you expect the federal response to eventually over-apply corrective actions to CPI inflation? And if so, how long to reverse course with the associated lag as well? So interpreting how the Fed acts this is a really good question. +2, Casey, on this. Good job, A-. One of these things, this is a really good question. So will they over-apply? So the Fed historically will always over-apply because that's what they do because of the nature of how they collect and manage data. Now, I think they're likely going to. I think what we might see, though, is the Fed being highly conscious of this and not necessarily living in a bubble. Everyone who's on the Fed board has intelligence enough to look at alternative measures and utilization. And the fact that this stuff is being talked about by economists at the upper echelons of policymaking suggests that they're aware of this data. And if I'm the Fed, I raise rates next time by 75 basis points again, 0.75%. Then I'm going to wait and see. And then I'm looking for a few things. How the job market responds in particular is important. And then we're going to start seeing these inflationary numbers come down. The Fed created an asset bubble. It helped create an asset bubble. It reduced interest rates for a long period of time. It started buying a lot of mortgage-backed securities, creating a market and priming the pump for the massive increases in real estate prices that we've seen, helping mortgage rates drop with the 10-year. And now we have a situation where that is no longer sustainable. Asset prices at that level aren't sustainable, but the problem is housing is also fundamentally guided by a lot of core supply and demand concerns that often are above and beyond what the Fed can control. It is true, we have not built enough housing in the last 15 years to accommodate demand for housing. And housing is also one of those things that even in the area of remote work, where you have a surplus of housing, industrial regions of the Great Lakes versus where you have a shortage of housing, say many towns across the West. One doesn't want to live in the areas like you're not going to pick up and move to Erie, Pennsylvania, even if you were to work remotely for cheaper real estate necessarily. Labor markets are not as fluid as we'd like them to be. And so as a consequence, I think that it's going to be messy. So I think in this case, this is a really good question. Let me go back. There's so many other things. Hold on, Casey. So I think the Fed is going to try not to overcorrect. They know they're trying so hard not to overapply corrective actions. I think we're going to have another rate increase coming along down the line. And then I think they're going to wait and see depending on the nature of the data. And I think if we see a combination of disappointing job market data, disappointing retail sales, and a pullback on inflation, and when they look at core CPI and regular CPI, if they see those numbers drop 7, upper 6s, they're going to start easing a bit and letting it slide and seeing how that works. And we might go through a month where they don't have any policy decision. And then the next time they meet 2 months later, we're going to see they're going to reassess. And so I think they're going to be careful on it, but I think they still might be wrong. So JPOW never over-applies. CPI can be 200%, and JPOW will say, to avoid spooking the market, 25 bips. You're right. I mean, we had that last time. JPOW is, if anything, a market. He knows exactly what the market expects of him. Would there be a scenario where JPOW looks at everything that is happening, like stocks, mortgage bonds, and realize maybe he's gone too far, like existentially, like he's writing a novel about himself, like he's, this is like, that's really funny. Like he released it. He's holding, a snow globe, and it's like Citizen Kane, and he drops it, and he's realizing I've gone too far, and the snow globe has like economic stability in it. No, I don't think that's going to be. That's a deep Citizen Kane reference, but I don't think so. But I think he's highly conscious as to the world around him and his expectations within it. But again, and here's the hard part, the greatest minds, we were really bad about predicting the future. And so as a consequence, even if you have everybody of power thinking a certain way and doing this way, and then he has his army of economists working for him and around him and in the board supporting him, helping him make these decisions, ultimately, it is still very, very hard to get right. And if he does get it right, luck will form a portion of that. And if he does get it wrong, luck will form a portion of that. And it's a matter of how you look at this in response to the data you have available. And as you can see, we were really bad, meaning us as a field, at predicting the longevity of inflation. And so that does not give me hope that this is the case. I know Jamie's never looking out for interest. Maybe not. I mean, he's looking out for Jamie's interest, but I think he's looking out for Jerome Powell's. He's looking out. Yeah, that's a really good question. He does, I think, at his heart of hearts, value economic stability and economic growth, because that is what's shouldering him. Interest rates lowered in 2023, that would be in response to recession. So the real question is will we see a recession in 2023? And we saw the news that, Jamie Dimon, I'm sorry, came out and said that there was a greater than 50% chance of recession. I think 50-50 is pretty good for a recession. I can't go more than that because I'm still holding out hope that the way the market responds, this is a very, very strange market. I think in terms of a true recession, one that has an adverse effect on economic recovery, meaning that we see job losses and we see reassessment of industries and we see people laid off, all that bad stuff, I think that stands at a 50-50 rate next year. And I think as a consequence, once that data came in, the Fed would ease gradually into that position. And you would see, and the question is why gradually? So I think they will, depending on the severity of it, that's going to dictate the type of economic response they have. But I guess the story of hope is that because they've raised rates so much, they do have a lot of leeway to stimulate the economy if they need to. It's really funny. When you see J Powell at press conferences, the man looks like he could use some sleep. Agreed. And if it lowered in 2023, what would it lower to? Surely not zero again. Well, I mean, yeah, if the recession's bad enough, zero is always a possibility. So right now it's very interesting. So if we look at the way that people are talking about this data, people are looking and saying, oh, this is finally the return to normal interest rates that we've seen for a very, very long period of time. It doesn't really work out that way, though. I know you can't just raise rates to what they were 40 years ago and not have consequences to the economy on that, especially the way that people have structured, utilized, and sort of marshal capital in response to investment decisions. Those behaviors change in response to market changes. And so when we think about things like the market and Jerome Powell's response to this, he's going to be looking at he's still sticking to this rate. I think the Fed will accept a higher than 2% inflation rate. I think that's true. This has been tossed around for 20 years in big economic circles that a little bit higher inflation, like 3 or 4%, is probably okay for the market. And I would view that if he got inflation down to 4%, he would consider it a policy victory. And then he would probably reduce any further increase of interest rates if inflation drops to that level. And maybe that number is 5, maybe it's 4. But I think at that level, he's going to drop it. I think at 6%, he's going to slow it down to almost nothing. But then if we look at the question and says, okay, what if we see job market losses? I think he would, if we saw an economy that had inflation at 4% and job growth and say unemployment rate increased to 5%. But there wasn't a lot of other negative situations. Let's say that there was still pretty good. Some industries were doing really well. I could see him lowering gradually. If it ended up being a shock, real estate prices drop, we see failures across some companies. We see a large, and this is unlikely. This is the catastrophic recession environment like we had in 2008. But this would be a situation where they would cut rapidly and cut down to zero as soon as they could to keep the economy afloat. And there's going to be some things that are unanticipated. The global market is one of them. Obviously, the Russia-Ukraine crisis and war is a big factor in this. What Europe does as it survives and navigates the higher gas prices through winter, what the UK does. All of this affects markets because it affects the liquidity of markets. And the Fed also responds to the availability of capital in the market, aka liquidity. And so they're going to see, they're going to adjust their policy expectations based on what the market's actually going to look like in different capital regimes. It is possible that we could be a victim of an international contagion in this market, in which the Fed would then have to respond very rapidly through very dynamic policy decreases. Everything is on the table, Albert. That's the moral of this story. Everything is on the table, but we don't have the data yet to support any of those moves. We are just seeing the market respond to higher interest rates. And it's starting with those apartment rents, it's starting with everything else, and it's going to continue with the rest of this. There is a lag and there is a delay, and this is a critical time we're entering now through January as we respond to the market interests. And that's where we're going to have it. So keep your eyes on the prize. Be careful in your investments, but be wise. There's always money to be made and always good investments to be had, but keep an eye out for anything. Okay, what do you guys got? Questions? That's all I got in my slides. I know we had a lot of questions. We took a little bit more time than usual. I can't believe we have 12 incredibly bold people, 10,000s of people who stayed with this. Thank you, guys.
Well, we are at time, so I think that was the last question. Any last takers? Albert wants more questions.
One more question.
I mean, I can always come up with questions, but I think we want to respect people's time, and we'll wait for more data to come out next month.
No. Is that too much of a hedge on the projections? Okay, if you want a Riley guess, right? And then you want to play it back and see if I'm right. So I do think there's a high likelihood the Fed will overshoot. And I do think we'll enter a recession. And then I do also think that the strength or level of recession will be also affected by international markets that are unpredictable at this moment. And I don't know, depends on a resolution of the various wars and other things that are happening. So final advice for job seekers. Yes, so as you get on this market, so here's the deal. Here's a level playing field. This is a great job market. Maybe you finally had the wherewithal, the chutzpah to step out and say, and the boldness to quit your job that you hated for years, and now you're looking for another one. Get that new job sooner rather than later. You can do it. There is enough concern over the long run, particularly if you are entering a position of some churn or where there might be some historical vulnerability during recessions. Be careful around some companies, especially if you're newly tenured at a new firm. And as you approach the market looking for a job, I mean, do look, and I mean, this is going to be a volatile year and a half. Now is the time to resign. That's not the advice. Is that official Albert's list advice? Is that official Albert? No, Albert. No, it's not the time to. No, I mean the thing is,
if you have a job in hand,
I would actually, I'm going to be contrarian on this, and I'm going to say this thing, and and I know that we've had some people on this before, and Sean and I have talked back and forth on this too. So I think it's going to be volatile for a long time, and I think right now this is as good as the job market gets, relatively speaking. We have the lowest unemployment rate, we have the strongest amount of confidence. It also means that as we turn, the job market will turn with it, and I wouldn't assume that any job is relatively safe if we enter a recession. And I think what we're going to see is as firms cut back investment for no other purpose, the Fed's going to raise interest rates, and as a consequence, that makes investing more expensive. As they cut back investing, that's going to reduce the number of opportunities for new jobs. We've seen the number of job openings decrease. That will continue over the next few months. And so note that, expect the job market to tighten. It will get a little harder to get a job in the next few months. And so I do believe that to be the case, at least until we kind of reach or the Fed eases or finally eases this contractionary environment. So with that in mind, it's going to get harder every month. And I think that it's easy now, relatively speaking, but be careful out there. Obviously don't stay in a job because you hate it, but change, be careful as you approach the next few months in making your job related decisions. Because there will be a period of time where it will be harder to get a job, and that might become sooner rather than later. He says nefariously, happy Halloween. That's right. And that's the thing. When you do change jobs, though, new employees are always vulnerable. Probationary employees are always vulnerable. 6 months probation, 1 year probation. This is the hard part about this. Like this is, and I don't want anyone to stick with the job they hate. But at the same time, though, being a new employee somewhere else, having less seniority, you might be on a list to be on the chopping block early, and that's really hard. So you're looking ahead of economic volatility, and this is a really good question. So what companies do well in periods of economic utility? So we have a bunch that do well. I mean, things like utilities do well. Government work, which nobody wants right now because they don't pay good wages, actually is relatively safe in economic times. Even if we look at the way that municipalities and states collect revenue, obviously a budget surplus in California this year. But in economic recessions, these are a little bit delayed. So a lot of cities don't receive, for instance, if you work for a city or a municipality or a state or county, you won't see sort of downward trends in your takings and your revenues until usually 1 or 2 years after the recession. In 2010, that was the worst year for municipalities in this country. That's where they actually bottomed out in the amount of money that they brought in. It was 2 years after the recession began. Those are often very more safe places, but they pay less. Utilities pay less. Healthcare is also something that is fairly good at handling recessions. But things like dentistry, on the other hand, is something that is often prone to recessions. Higher education, other things like that do well in recessions. So one of those things, maybe. So, but technology is most volatile. Only the biggest industry.
Only obvious, especially for Albert's list members, probably.
Yeah. So just be careful, get your seniority, get all the stock options you can, rock and roll, maximize your compensation benefits and see, and ride the wave. And you'll make it through okay. And that's, I've been through these environments. And for me, it was writing on the wall in 2008, working in a bank in the worst time ever for banks. I know what it's like. So any thoughts on how Google, Meta, Salesforce, Cisco, eBay, or those big tech companies will do then? This is a really good question. You're going to see, my guess is, in the event of a recession, you're going to see the typical sort of cost cutting that companies do in response to economic changes. Now, of those companies, would I argue that one in particular would represent any level of vulnerability? That's really tricky. So let's see here. So obviously, they're all reliant on consumer spending and an appetite in some way for either advertising or spending to fund them. I think they're all going to be vulnerable in very separate reasons. Salesforce, obviously, so important with their integrative technologies for businesses and software and other things. And then companies might cut back investment. eBay, for instance, heavily reliant on consumer spending. Google, on the other hand, has a million ways to make money, but they're still prone to things like advertising revenue and other things, and search engine optimization, and those things dry up in bad economic times. And so the interesting part about all of this is that we don't actually have a good comparable to this, because even if we have this, look at the number of those companies that were publicly traded in the last recession. And then you ask yourself, okay, every recession behaves slightly differently. And so I would say that fundamentally, think about the projects you might be working on and think about the importance of how tied to commercial success those individual products are, how risky they are. Companies in times of economic duress cut down on riskier ventures. They cut back and ultimately often focus on what they do well or more reliable money makers. And so I think, think about the division you might be in, think about the area you might be in and you're working, and think about your relative vulnerability relative to the rest of the company. Because when you have a company where you're employing thousands of people, ultimately you become a number, and a strategic decision that involves this will axe divisions that underperform or have no long-term economic benefit for the company, or they underperform because it's a recession and they're responding to economic changes. So it's a complex question, and it will be different for every one of those things. If retail spending cuts back, I'd say it's bad news for eBay. If we see a lot of bad corporate numbers, that could be bad for Salesforce. And all of these things, and it's likely a combination of all these things. So that's a separate question. We'll have to look at these, but they're all going to be prone to some layoffs in a recession, should there be one. And again, I'm still saying 50-50 on that right now, because I still think that, the job market has been surprisingly stronger in the same way that inflation has been surprisingly terrible. So we'll see what the next year has.
I got a weird question, but I don't know if we can answer it without wasting too much time. But
okay, I'll be brief.
The new rule where next January, California will require companies to post the salary bandwidth for jobs.
Yes.
I'm going to ask, how you think that would affect the job market on a macro scale? Like, would companies flee California since that's what they always threatened? Or would that is that ultimately good for California job seekers? Or is that ultimately going to be bad?
So that's a good question. So I think it won't have a big effect, and here's why. And I think that, and the reason I think it won't be a big effect on the nature of how people do in new business is that, okay, let's look at the availability of salary information. It already exists in some sectors, government work, for instance, right? And you look at this, and I see your point though. You're actually asking, relatively speaking, will people move to a state where their salary can be secret? Certainly I'll be able to find anecdotally people who do this. But the question is, though, when you think about this, will companies themselves move in response to these reporting requirements? Universities report on salaries. Every salary is ultimately lookupable via Sunshine databases for government workers right now. And this is just extending that into the private sector in a meaningful way. So that being said, is in the same way, people didn't leave government because their salary was posted. People left government because their salaries were terrible. I think transparency in this is going to spread to other states in the country. And I think ultimately, from a matter of equity and from a matter of just looking at people's general point of view on how much they get paid, until there's, I don't know how this will evolve. I think it's happened so successfully in government that I think it's going to be a blip on the radar. And I don't think companies will be like, I'm going to move somewhere else, so I don't have to report my salaries of my workers on this. I mean, and if they were hesitant on that, you'd ask yourself, why don't you want to report the salaries of your workers? You underpay them? Are you paying them too much? Are you paying them inequitably based on certain characteristics of your employees? And then it also asks the question is, why the hell do you want those companies in California anyway? But I would ask yourself, think about it from this perspective. That's a good question. And my bet is it won't affect things in the long run. And I think it's actually going to be something that we'll see more of, is transparency in this. Because I mean, I work in a field where everybody can look up everybody's salary any day of the week, and it's the thing, and they often do. And then they often talk about it at meetings, and it's very, very annoying. And that's how you'll manifest itself. It'll make your meetings much more annoying. And there'll be that one person who'll be like, I only get paid this much, but I noticed you get paid this much. And you're like, yes, because I'm a programmer and I do this and I have 3 master's degrees. And they're like, no. And it's one of those. You'll get into fisticuffs, but it'll be fun.
I don't know if meetings could be more annoying.
You'll have to. Oh man, it's gonna be a ride, but it's like welcome to the government, everybody. So that's the thing. Everyone does it. Oh, they leave out things, but yeah, we have sunshine databases here and everywhere else. So it's a thing. And it does help. It does help equity, and it helps long run, people's perception of their jobs. But I think people will stay in. I mean, this is the thing. People, as annoying it is to appreciate when you're stuck in traffic, it is a beautiful place to be, and it's still going to be a source of. It's still going to attract a lot of the best and brightest in the country in the Bay Area. We'll find. You already have, the deepest and most competitive market for technology-related employees in the country. So the fact that any of you who are succeeding in this field are doing so right now, or even if you were laid off and finding another job, you're doing so in the most competitive market for this in the world. And that's amazing. And you should feel very good about this, and good about your jobs and good about your placement. That's my 2 cents.
Very uplifting. All right, we are at 6:50, so 20 minutes past our scheduled time, but I feel like the last 20 minutes was definitely worth staying for. I hope everyone feels the same, and thank you everybody for attending tonight's webinar. If you have any final questions, drop it before I end the call. But we hope that with this information, you feel like you learned something and you're more educated about the market's macro and micro effects on your job search and your compensation, and whether you should be quitting your job, as Albert suggests, and go resigning and finding something new. As noted, this was recorded and will be put online within 7 business days, and we hope that other events will interest you. Let me drop the link for other events quickly.
We don't have other events. It's okay. There's no other events on lot that are going to be up except for really the next event for this.
Okay, well,
after the next CPI report.
I hope that next month's will be more interesting as well. And in the meantime, have a wonderful night and happy Halloween.